As of late July 2026, Bitcoin is trading around $64,700 to $66,000, having rebounded significantly this month. Yet this isn't happening in a vacuum, it's occurring amidst a macroeconomic environment that would typically stifle risk assets. Isabella, what's driving this seemingly counterintuitive resilience?
That's a great observation, James. The dominant macroeconomic theme is certainly higher for longer interest rates due to sticky inflation. The Federal Reserve has held the federal funds rate steady at 3.50% to 3.75% all year, and the data is stubborn. May 2026 PCE hit 4.1% year over year, and June CPI was 3.5%. With markets pricing in a meaningful chance of at least one more rate hike this year, supported by elevated 10-year Treasury yields near 4.63%. Historically, this pressure should weigh heavily on speculative assets. We've even seen capital rotate into AI equities as investors search for different types of growth.
So, if the macro backdrop is so restrictive, why isn't Bitcoin suffering more, especially after its 2025 peak near $120,000 to $126,000?
That's where institutional channels act as a buffer. A key support for Bitcoin has been the massive cumulative inflows into U.S. spot Bitcoin ETFs since their launch in early 2024. Reports indicate these ETFs have seen tens of billions of dollars, with one citing over $58 billion for BTC ETFs and up to $87 billion globally for crypto ETPs in comparable periods. Q1 2026 was particularly strong, with about $18.7 billion in total crypto ETP inflows. While flows were mixed in May, we've seen a recent positive streak, including $727 million over the 5 days ending around July 21st, with BlackRock's IBIT consistently leading.
So ETFs are providing a persistent bid for Bitcoin despite macro headwinds. Is this fundamentally changing Bitcoin's market structure, moving it away from a purely retail-driven asset?
Absolutely. Analysts are framing this as Bitcoin maturing into a portfolio diversifier akin to gold. This broadening institutional participation from wealth managers to RIAs is creating a supply shock narrative. The ETFs are effectively absorbing post-halving supply, which supports the price even when retail interest wanes. It's a shift from pure hype cycles to fundamentals-driven participation, bolstered by the fact that some of these flows also represent arbitrage and basis trading.
Beyond institutional adoption, regulatory clarity has often been cited as a hurdle. Is there any significant progress, or is it still a patchwork of uncertain rules?
We are seeing a clear shift from enforcement to framework building. First, the Genius Act for stablecoin regulation was signed into law by President Trump in July 2025. It established the first comprehensive U.S. framework for payment stablecoins, covering reserves, licensing, and consumer protections. Its implementation is actively underway, which is bullish for stablecoin growth, on-chain USD liquidity, and DeFi.
And what about the broader market structure? Is there any movement on the jurisdictional tug-of-war between the SEC and CFTC?
That's where the Clarity Act comes in. The House passed it in 2025 with strong bipartisan support, and Senate negotiations are ongoing. This act aims to create clear jurisdictional boundaries, primarily assigning the SEC authority over securities-like assets and the CFTC over digital commodities. Industry voices, including the CEO of Goldman Sachs and the Trump administration, are urging its passage to cement U.S. leadership. While full passage is uncertain for 2026 and could carry into 2027, any meaningful progress or a vote before the August recess would be a major catalyst.
Given these forces, how does this position Bitcoin within its historical 4-year halving cycle?
The analysis suggests the 2024 cycle peaked in late 2025, followed by the expected correction into 2026. This year is viewed as a consolidation or accumulation year, with 2027 potentially setting the stage for the 2028 halving. However, ETFs are muting these retail-driven cycles. Price predictions for end 2026 remain highly divergent, ranging from bearish scenarios in the $60,000 range to bullish targets exceeding $150,000. But the consensus is that this year is about base building.
Looking ahead, what are the immediate milestones we should watch?
In the immediate term, the late July and early August window is critical. We have the FOMC decision, Powell's press conference, and the latest PCE inflation data. For the rest of 2026, the market will remain macro-sensitive and volatile. The recent rebound is encouraging, but sustained upside likely requires cooling inflation or Fed signals that reduce hike fears. The medium term into 2027 looks like a transition towards structured, institutionally anchored growth with legislative clarity and maturing infrastructure serving as long-term tailwinds.
It sounds like 2026 is a pivotal year, laying the groundwork for future growth, even with continued volatility.
Precisely. The market is shifting from hype to fundamentals-driven participation. While macro is the primary short-term swing factor, foundational elements like institutional rails and emerging regulatory frameworks are strengthening, paving the way for more sustainable adoption.
If you found this discussion insightful, share this episode with someone else who might appreciate understanding the complex forces shaping the crypto market.